TheoTrade. This is Don Kaufman. It's May 22nd, 2019, and you are watching the TheoTrade evening video. Well, another day kind of grinds by in the S&Ps, which are effectively down 5 with about 15 minutes left to the cash close. The Nasdaq's largely unchanged. The Russell, though, happens to be taking a little bit on the chin as the bonds, they've kind of retrenched, headed a little bit higher. You know, one of these things in the bonds that I really want to point out, I mean, people, come on, they are poised. I mean, poised for what? Possibly a wicked breakout to the upside. Just as a reminder, the recent high in here was just north of about 150, but this time around, again, a bond above 150 would likely actually spark some sell-side activity, specifically inside of the financials. So in trade today, you know, you would think that the FOMC minutes that came out kind of midday might spark a little bit of movement in this bond market. Absolutely nothing. You would think that the FOMC minutes that came out today would possibly move the S&Ps. I mean, in this particular tape, you can't even tell, it was right here, but you can't even tell when or where those FOMC minutes came out. By the way, what did we learn about the FOMC today? We learned that they're doing absolutely nothing, but there's an interesting kind of note on that front, and that pertains here. This happens to be the probabilities involving a rate increase or a rate cut. Now, I've displayed this a number of times. I'll just take you into just a little bit of brief detail. What you're looking at, this is the CME group. It's called the Fed Watch. This is where rates currently are. Here are all your meeting dates. So what the Fed said in the minutes was that right now they're just happy waiting, that there's not going to be any rate change. They didn't actually tip off to be a rate cut or a rate hike. So one of the first takeaways is here under this meeting probabilities, this is based on a live market. Like, this isn't, you know, some like, all right, let's just create a probability chart. This is all based on live markets. So they're looking at Fed fund futures. Okay, and they're taking the pricing in Fed fund futures and converting those here at the CME group to probabilities. Okay, what's the probability of a rate increase? Well, right now the marketplace has absolutely no chance of that anywhere between now and, again, January of 2020. Okay, but what the Fed effectively said today is that we want to wait. We're not going to do a rate increase or a rate decrease. The market, though, doesn't believe it. I mean, take a look. There's still a 30% chance of a rate cut in the September meeting, even though, again, they said basically you got a stay of execution. Rates are going to be what rates are going to be. And then the marketplace only gives us a 50% chance basically of staying at the current rate. They're pricing in a 50% chance of a cut by the October meeting. And that's why I wanted to kind of detail that for just a moment, because effectively the marketplace is saying something very different than the Fed. Right? And the marketplace is starting to have a little bit of, if you will, disbelief as to what the Fed is effectively doing. All right. With that, I think there's kind of a pause in the markets right now, and it has a lot to do with some of the news coming out of China, or you could actually say lack thereof. China hasn't necessarily been quiet, okay? Nevertheless, they haven't actually done anything to retaliate yet for the tariffs, okay? And they definitely haven't done anything to retaliate yet for Huawei and the other firms that are now being impeded upon, okay? I would fully anticipate some retaliation, and kind of makes a lot of sense. Here in the U.S., we're coming into a holiday weekend. Memorial Day weekend's coming up. Things are fairly quiet. Hey, why not take a shot across the bow when they have that opportunity? Now, it appears that Apple is already pricing in, okay, a fairly good degree of risk. At this point in time, I mean, Apple on a year-to-date percentage, it was up like 33% year-to-date. Now it's only up 16%, okay? I think it's difficult at this point in time to want to hop on that kind of bearish bandwagon. You know, it is very plausible, okay? And again, I would say a high probability that China is going to take some degree of a shot at Apple. Nevertheless, looking at this, again, the implied volatility has actually picked up a little bit here in Apple, okay? The chart obviously reflects that Apple is going to be a target, no question about that. That's not the area per se that I'm looking for a trade necessarily to play out. Okay. I happen to be looking in a very different, okay, kind of, and looking at this from a different perspective. There's been a lot of discussion, okay, around what they term rare earth. And for those of you not kind of in the discussion, there's not necessarily the easiest, like, ETF, like what are rare earth materials? There's no easy ETF for that, okay? But the ETF I happen to be looking at is XLB, okay? And this just happens to be generally the materials sector. And there's this tremendous discussion, okay, around China cutting off, okay, the US regarding, again, some of those rare earth items, materials, which would have actually an impact specifically here in the XLB. As such, what you look at in the XLB, sure, you could spend some time, look at a chart, and you'll see that the XLB has gotten completely and totally flat. But there has not been, per se, an increase in implied volatility. So if you look over volatility studies, implied volatility, what have you gotten here? Absolutely nothing, okay? Which can mean like, all right, this will be very passe. There's just, maybe the marketplace does not believe, okay, that they're going to take a shot at the materials sector in any way, shape, or form. But I do believe at this point, if you take a look at the pricing of the trade I'm about to show you, it's worth taking the shot at this point in time. Regardless if, again, China does take that shot at us, you still get a little bit of movement in XLB, and this is going to be a decent and profitable trade. Let me actually take you a little bit into the trade. I'm actually using, okay, a trade assuming that I do not know which way the materials sector is about to head. Okay, that's one of the first premises I want to give you in this particular setup. When I say, I don't mind saying that. Listen, we don't know how this is effectively going to play out. So if you don't know how it's going to play out, okay, and the product is trading, let's call it at 54, you want to trade, we're going to have a degree of profitability if we move, right? If we move what? Higher, if we move considerably lower, we're going to look for that kind of profitability. Now, what can you really do with a $54 product? Well, the volatility is 20%. It's not exactly rocking there. But again, the anticipation is this ETF is going to move higher or lower. Given the fact that the implied volatility, and there's a reason I pointed that out a moment ago, the implied volatility is sitting about 20%. So it's not half bad to want to go out and maybe buy some options. But I personally, I don't like the idea of just going out there. And some people love this. They're just, I'm just going to buy me a straddle. Right? And you could just buy a call, then turn around and buy a put, and you got yourself a straddle. But then you need like a $2 plus move just to be able to break even. And that to me is it's just plain wrong, right? It's just plain wrong, a $2 move. And the reason I don't like it is because right there, you're only really anticipating about a $2.50 move between now and 30 days from now, right? So let's get a little bit more creative. As such, I actually created what's termed a double calendar. Some people refer to it as a double diagonal, but it's a double calendar. And I'm basing that calendar, it's the 56 calls for July against the 56 puts, okay? Against the 56 calls from July. So in this particular trade, as I'm looking at the put side, let's go through the call side of the trade first over here in the trade tab, and I'll kind of recreate the entire position. So what it kind of comes down to is I've just created two, okay, separate calendar spreads, one call calendar spread and one put calendar spread. In June, I'm going out and I'm selling the 56 calls for June. Then, okay, I am simultaneously turning around and buying the 56 calls, okay, for the month of July. So here's my call calendar spread. Now let's just take the calendar spread for a second. Let's drop it over to the Analyze tab. Let's uncheck the diagonal. If I just did the call calendar side of it, okay, here's where we're currently at. We need a little bit of a rally, okay, for me to see degrees of profitability. Now, the top of this tent, you're not going to get the top of that tent. You're going to get somewhere maybe in this neighborhood, right? Which is, again, reasonable, feasible. It's not a half bad return. So that's the call side of the position. Now, on the other side of the position, I'll knock that one out of there. On the other side of the position, we did the put spread. Okay, and in this case, well, we did kind of a put spread that was opposing, okay, equidistant, and I sold the 52 puts. Let's go ahead and delete that out. We sold the 52 puts in June, turned around and bought again the 52 puts in the month of July. Go ahead and analyze this trade. We're going to analyze it. All right, so analyze this trade. This is the put side of it. Again, here's where the market effectively is. Okay, this is the upside of it. So what am I really trying to do? Well, I'm trying to kind of entrap where the stock happens to be. So here is, again, it's a double calendar spread. So the double calendar spread can achieve degrees of profitability slightly higher or slightly lower. And really where I'm looking for this is about a $2.50 move higher or lower. Now, inside of this trade, one of the things I'm not necessarily going into too much detail, and I will, during the course of TheoTrade live in our chat room, but there's going to be roll opportunities in here as well. Even though I'm starting the trade by using a standard June and a standard July, okay, we're also afforded the ability to roll the position as there's going to be multiple weeklies involved. Okay, so eventually I can roll from the 30-day to the 37-day and roll this trade out and have a couple of different opportunities to hit degrees of profitability. Nevertheless, the point being, we expect a bit of a move inside of the materials sector. Again, this is predominantly designed to take advantage of, hey, let's see what China does, okay? Even if China does nothing involving rare earth materials, okay, our materials sector is still likely to have influence from the overall market and still see some degree of movement higher or lower. Again, the materials sector has been incredibly flat over the last 2 weeks. Regardless of what you might think about the China situation, the trade still has a degree of effectiveness associated with it. So here we sit waiting, okay, for China kind of retaliation. I think most people expect it, okay, that shot to come towards Apple. Nevertheless, okay, the rare earth side of this equation could really come into play. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.